Investing in the financial markets can be lucrative, but can also be very stressful, as so much can be lost in the blink of an eye. The most successful stock market ninjas are so because they follow routines and strategies that they have developed themselves or learned from those that came before them. Today, in this video, we're going to go over some of those strategies that have been proven to help your gains. Get comfy and pay attention as we show you 10 things to do to invest like a boss. Number 10. Have an open mind. Many great companies are household names, but many good investments lack brand awareness. Furthermore, thousands of smaller companies have the potential to become the blue-chip names of tomorrow. Small-cap stocks have historically shown greater returns than their large-cap counterparts. From 1926 to 2017, small-cap stocks in the U.S. returned an average of 12.1%, while the Standard & Poor's 500 index, S&P 500, returned 10.2%. This is not to suggest that you should devote your entire portfolio to small-cap stocks, but there are many great companies beyond those in the Dow Jones Industrial Average. Number 9. Play the long game. Always look to the future. Investing requires making informed decisions based on things that have yet to happen. Past data can indicate things to come, but it's never guaranteed. In his 1989 book, One Up on Wall Street, Peter Lynch said, quote, "If I'd bothered to ask myself, how can the stock possibly go higher? I would never have bought Subaru after it already had gone up 20-fold. But I checked the fundamentals, realized that Subaru was still cheap, bought the stock, and made 7-fold after that." End quote. It's important to invest based on future potential versus past performance. While large, short-term profits can often entice market neophytes, long-term investing is essential to greater success. And while active trading, short-term trading can make money, this involves greater risk than buy-and-hold strategies. Number 8. Make investing automatic. Do not give yourself a chance to fail. Once you decide to regularly invest smaller amounts of money, it's important to make a commitment to a specific plan. If you just figure you'll invest whatever you have left at the end of each month, you'll probably find that whatever often translates to nothing. Then, the best way to make sure you follow through on your commitment is to move the money out of your bank account before you ever get a chance to spend it. If you invest in mutual funds, you could set up automatic investments to make it easier to stick to your plan. Not only is setting up automatic investments a way to simplify your life, but it's also just smart investment behavior in general. It removes the pressure to decide when to make each investment, sidestepping the possibility that you'll be too indecisive to make any move at all. Number 7. Diversify your bonds. Wu-Tang Financial. By including asset categories with investment returns that move up and down under different market conditions within a portfolio, an investor can help protect against significant losses. Historically, the returns of 3 major asset categories, stocks, bonds, and cash, have not moved up and down at the same time. Market conditions that cause one asset category to do well often cause another asset category to have average or poor returns. By investing in more than one asset category, you'll reduce the risk that you'll lose money, and your portfolio's overall investment returns will have a smoother ride. If one asset category's investment return falls, you'll be in a position to counteract your losses in that asset category with better investment returns in another asset category. In addition, asset location is important because it has a major impact on whether you will meet your financial goal. If you don't include enough risk in your portfolio, your investments may not earn a large enough return to meet your goal. For example, if you are saving for a long-term goal, such as retirement or college, most financial experts agree that you will likely need to include at least some stock or stock mutual funds in your portfolio. The famous Chappelle Show skit featuring the Wu-Tang Clan was spot on. Diversifying your bonds is the first step to making money in the market. Number 6. Emotions are for the weak. Investing is a long-term commitment, usually meant to bolster retirement funds, not fund your next big-ticket purchase. Investors who trade too often based on market fluctuations are making it harder on themselves. Over the short term, market behavior is often based on the alternative virtues of enthusiasm, or hype over a new product, or the lack of it. But over the long term, the bottom line, company earnings will determine a stock's value, and companies with a solid foundation can withstand quite a bit of flack, so keep your feelings out of it and trade cold the way Iceman flew in Top Gun. Number 5. Do not be scared. Risk equals rewards. All investments involve some degree of risk. If you intend to purchase securities, such as stocks, bonds, or mutual funds, you must understand before you invest that you could lose some or all of your money. Unlike deposits at FDIC, insured banks, and NCUA, insured credit unions, the money you invest in securities typically is not federally insured. You could lose your principal, which is the amount you've invested. That's true even if you purchase your investments through a bank. The reward for taking on risk is the potential for a greater investment return. If you have a financial goal with a long-term horizon, you are likely to make more money by carefully investing in asset categories with greater risk, like stocks or bonds, rather than restricting your investments to assets with less risk, like cash equivalents. On the other hand, investing solely in cash investments for short-term financial goals. The principal concern for individuals investing in cash equivalents is inflation risk, which is the risk that inflation will outpace and erode returns over time. Number 4. Buy low, sell high. The advice seems obvious. Buy stocks when they're priced lower, sell them when they're priced higher. But it can be as different as walking away from the Vegas blackjack table when you're on a winning streak. To protect your stock portfolio from above-average risk, harvest the stocks that have done well and put those gains into stocks that have underperformed. It seems counterintuitive perhaps, but that's the essence of rebalancing a portfolio. So if your stock standards deviation is 15% and it drops more than 15% in a short period, it may be a good time to rebalance and buy more of that stock, because you know it'll likely go up again. Number 3. Manage expectations. The stock price is based not on performance, but on how investors think it will do. We all hear the rags to riches stories of stock investing. A little-known company hits it big and thereby makes all of its stockholders rich. But notice that first qualification. The company was little known. Too many investors fail to understand that the market's expectations for a given company are built into the stock price. For example, it's not enough to invest in a company that will have above-average growth. You need to find a company that will grow more than the market expects it to. That involves doing better analysis of a company's future growth rates than all of the industry's highly trained professionals, which is both difficult and unlikely. Number 2. Save early, save a lot. Saving early allows you to take advantage of the power of compounding. If person A saves $5,000 a year from age 25 to 40 for a total of $75,000 and then never invests in another penny, and person B invests $5,000 every year from 40 to 65 for a total of $125,000 invested, assuming 5% growth, person A will end up with more than $400,000 by retirement, while person B will only have $256,000, simply because person A started saving earlier, even if he or she puts away less. Number 1. Minimize taxes. Various investment accounts offer different tax benefits. For instance, a Roth individual retirement arrangement levies taxes on your contributions now, but allows your investments to grow tax-free. Employer-sponsored accounts like 401k and 403bs allow you to defer taxes now, though you'll have to pay Uncle Sam when you withdraw the money during retirement. Some people have additional investment accounts, since retirement accounts limit annual contributions, but these accounts are taxable.